With dividend yields of 8.48% and 7.67%, a lot of investors have been interested in Verizon and AT&T stock. But given that these two companies have a massive $296 billion in debt, should investors avoid AT&T and Verizon stock because of this massive debt?
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Well, that's the question I'm going to answer in this video by looking at the company's total debt, the interest rate, when that debt is coming due, comparing it to their cash flow and their valuation to answer that question. Should you avoid Verizon stock and AT&T stock because of that massive debt? So let's get right into it. Now, the big trouble with long-term debt nowadays is because of rising interest rates. And I could show you a chart here of what's been happening with the 10-year note here. And in around January 2021, the 10-year government treasury bond was earning 0.82%, 0.84%, I'm sorry. And now that yield is up to 4.5%. So government bond yields have increased dramatically over the last few years as central banks and inflation has taken hold and investors are requiring a higher yield in order to invest in these government bonds. And the reason why that's troubling for companies like AT&T and Verizon is because their bonds are considered riskier than government bonds. So as an investor, as someone looking for interest rates, as someone looking for yield, you're going to require more than what you would on a government bond. So if a government bond is 4.5%, a 10-year government bond, from Verizon and AT&T, you're going to want something at least above that. You're going to want something at least 4.5%. So the rising government bond yield is requiring investors to ask for rising yields from corporates like Verizon and AT&T. And so that's why it's difficult for Verizon and AT&T right now, because government bond yields have increased, and so investors are asking for higher interest from corporations. But there is an interesting fact to consider due to this, and that's in relation to when this debt is coming due. So first off, let me show you here AT&T, of its over $143 billion in debt that it has, over $91 billion of it is interest rates of 5% and below, and over $115 billion is over $24 billion is at interest rates of between 0 and 3%. So a big portion of AT&T's debt is at very low interest rates, rates that if they were to try and refinance today, they would not be able to do that. They would not be able to get these kinds of rates again if they needed to refinance today. But the good news is that they don't need to refinance today. Let me show you that. So here I have highlighted AT&T's debt repayments that are coming due over the next few years. And what you'll notice is $6.9 billion is coming due in fiscal year 2023. $8.9 billion is coming due in fiscal year 2024, and $5.9 billion in 2025, $8.6 billion in 2026, and $6.2 billion in 2027. After these years, they have $110 billion coming due. So the vast majority of AT&T's debt is not going to need to be refinanced until after the year 2027, when interest rates are likely going to be much different than where they are today. They could be higher, they could be lower, but they're probably going to be different, and it's more likely that they're going to be lower than higher if I was going to make a wager on interest rates. So in 2023, $6.9 billion coming due for refinance, and the weighted average interest rate on these loans they're going to refinance is 3.7%. Undoubtedly, AT&T is going to have to refinance at higher rates, but management has also said that they're setting aside some cash flow to just pay off this debt and not refinance, just pay it off. And then use some, because if they were to refinance this debt this year, they're going to have to pay interest rates above 5%, maybe heading into 7, 8% to refinance this debt. So why not just pay it down? That's an effective use of cash to pay down something that would cost you 8% if you had to refinance. And then in 2024, similar story, 8.95 billion coming due, and this weighted average interest rate is 4.1%. So again, it might make sense for AT&T to set aside some cash flow to pay down this debt instead of trying to refinance it. And then in 2025, that debt that's coming due is at 5.5%. And so, when they are to refinance, the difference will not be that large because it's already at a weighted average interest rate of 5.5%, much higher than the 3.7% of the debt that's coming due in 2023. So overall, what you'll notice for AT&T is the vast majority of its debt is coming due after the year 2027, and the few billion that is coming due over the next few years, the company has options in just paying down the debt. They certainly generate enough cash flow where they can just pay down this debt if they don't get attractive interest rates to refinance at. So let me show you the same thing for Verizon. So here is Verizon and their schedule of repayments. In 2023, they've got 9.3 billion coming due. 2024, they got 16.2 billion, and it falls from there. And they've got about 100 billion of their total 149 billion in debt coming due after the year 2027. So Verizon, a little bit more than AT&T in terms of the overall debt that's coming due over the next few years. Especially in 2024, they've got 16.2 billion, a considerable sum that's coming due. And if they are to refinance, they're going to have to pay higher interest rates. So yes, these two companies have a massive debt load of over $140 billion each. But the good news is that most of this debt is not coming due anytime soon. They've got a long time to deal with this debt, refinance it, and perhaps even pay it off. So let me show you their prospects for paying off this debt. So we already looked at the total long-term debt. The company's paid in the last year, the trailing 12 months, AT&T paid a dividend of $8.1 billion, total dividends paid, and Verizon paid $10.9 billion in dividends. Massive sums of cash that if they needed to, if they were hard pressed, they can say, well, let's temporarily cut our dividend in half this year and use $4 or $5 billion to pay off some of this debt. They could do that, right? They could do that. But they probably won't need to, because look at their cash flow from operations in the trailing 12 months going back several years. In the last year, in the last trailing 12 months, AT&T and Verizon generated roughly $37 billion in cash flow from operations. $37 billion. That's considerably more than the dividends they paid of around $11 billion and $8 billion. So that leaves a massive chunk of cash that they can use to pay down debt if they wanted to, if they chose to, if the interest rates that they were seeing that they were having to pay to refinance this debt is prohibitively high, they can use this cash to pay down debt. So they can prioritize paying down debt because of the elevated interest rates. And that's really what management has been talking about throughout 2023, is that they are going to prioritize paying down debt. And they've also said that they're not going to need to sacrifice the dividend, or they don't expect to need to sacrifice the dividend in order to pay down the debt, because they've got plenty of cash flow to do both. Plenty of cash flow to do both, according to management. And then finally, these stocks are not expensive. AT&T and Verizon are trading at cheap valuations. Verizon trading at a forward price to earnings of 6.6. AT&T trading at a forward price to earnings of 5.8. So if these stocks were expensive and they had all of this debt, then I would say yes, the debt is a reason to avoid these stocks, because not only do they have massive debt, but the stock is expensive too. But in this case, their stocks are cheap, the companies are generating sufficient cash flow, and so I would say no, the total massive amount of long-term debt is not a reason to avoid Verizon stock or AT&T stock. So if you're a passive income investor looking to generate some dividend income from Verizon stock or AT&T stock, I think it's fine. The debt is large, but as I've showed you, it's coming due in increments that I think is going to be digestible for both of these companies right now. But before I let you go, if you've gained any value from this video, which you probably have if you've made it this far, please subscribe to the channel. It'll help me create more videos just like this one. Thank you for watching.